The rupee has breached the 65 mark now, surpassing the previous all-time low of 64.55 to the dollar. The markets followed the rupee, opening lower for the fifth consecutive session, but recovered as the rupee pulled back from 65. A fresh weakness in the rupee comes after minutes from the Federal Reserve's July policy meeting showing in the U.S. Central Bank was on track to start tapering the stimulus as early as next month. A Deutsche Bank report yesterday predicted the rupee slide all the way to 70 to the dollar in a month or so. My colleague Ashutosh Sharma now joining me from NDTV Profit for more on this. Ashutosh, clearly a bleak time for the economy. The slide to 70 to the dollar means really bad things as far as the consumer and the common man in India is concerned as well.
Absolutely, and the common impact, let's start with the most obvious. The first one, of course, would be that with every 1 rupee drop as far as the dollar is concerned, our import bill is getting bigger and bigger. And which are the biggest items of import? We are a net crude oil importer. I think that forms a significant portion of our import basket. So we might be in for another round of a fuel price hike. We already see diesel prices being hiked by about 50 paise every month, but there are reports suggesting that we might have to take more stringent and rather more drastic fuel price hike, whether it's diesel or whether it's some of the other fuels as well. For diesel, yes, a one-shot 2 to 3 rupee hike could actually ease up the under recovery burden for the government, but it's a very, very sensitive time. The elections are just around the corner, so how much can the government do? That's one. So one, fuel price hike. On the other hand, it also translates into higher cost of imported goods. Again, as far as electronic items are concerned, we've already seen the government banning import of flat panel TVs, import of gold and silver. Import duties have been hiked to about 10% as far as gold is concerned. So imported items tend to become much more expensive. Also, the recent measures that the RBI has brought in, first to tighten liquidity and then to ease it up a little bit, have sent mixed signals. But bankers that we've spoken to do believe that there is there's a highly unlikelihood that we might see interest rates coming down. So banks, if there is a liquidity shortfall in the system, may be actually forced to up base rate or the benchmark lending rates in some cases. So be prepared for perhaps some bit of a hike as far as interest rates are concerned. So a rising cost of imported goods, and most of them are in the consumer space, higher fuel prices and perhaps higher interest rate. These are the three factors which we might have to grapple with in the coming future. The rupee is not the problem in itself. The rupee is reflecting the problem that the Indian economy is facing. According to economists, we might be in for a sub 5% kind of growth as far as this financial year is concerned. And the fact that some of the recent steps by the policymakers have not gone down too well, whether it's capital controls, limiting dollar remittances overseas, limiting participation in owning foreign property. So these moves, which are reflection of what we used to do about 20 years ago when we were predominantly into capital control. So all these steps which the government has been taking in desperation are not sending out the right signal. So maybe more pain ahead for all of us, including the economy.